Hi, and welcome to the Intentional Wealth Update with Morton Brown Family Wealth for the first week of February in 2022. I'm Dennis Morton here with Katie Brown and Cody Demmel. How are you guys?
Hi, great.
Good. So I have a couple articles that we want to dive into today. Some of it related to how much we have in stock exposure. Some of us might have a lot more than we think. We also found an article about the perfect investor, and there's some threads that tie these together a little bit. Cody, why don't you start us off with this article from the Wall Street Journal about how much stock exposure older investors might have right now?
Yep. So their Wall Street Journal put out an article with some research from the end of 2021 from both Fidelity and Vanguard. Fidelity gave out some research that 40% of their clients aged 60 to 7 have around 70% in stocks. And then if we go to Vanguard, they came out and said 20% of their retail clients between ages 65 and 75 have over 98% in stocks currently.
So, Cody, there's a little bit of drift in there, right? Like, it's not people intentionally saying I want to buy more. They've just, stocks have just been growing for so long, right?
Yeah. So, I know we spoke about it a couple times over the past couple updates that the S&P 500 is up around 26% every year over the last 3 years. So there was a drift. Maybe you started in a 60-40 allocation, and now that 60% stocks has grown to around 70%.
And this can create a little bit of anxiety. Somebody might be saying, all right, should I be in a 70-30 portfolio, or 60-40 still makes sense? How do you think about that if somebody's wondering, do they have too much in stocks, especially as they're getting older?
Yeah, and it is kind of reflecting on and how would I feel if there's market volatility and the impact of that. You know, one of the exercises that they had suggested in the article was to think about the percentage of stock that you currently have, and now imagine that percentage being cut in half. And cut in half because, you know, during each generation, there are usually a couple of recessions that happen that you could see a drop in the stock market of 40 to 50%. I mean, many of us have experienced that, you know, through the financial crisis in our lifetime. And the likelihood of that coming back is probably strong at some point, who knows when. So if you imagine, if you have like 60% in stocks, say it's $1 million portfolio, 60% in stocks, and if half of that goes down, your portfolio could go down to 700,000. And then to think, okay, how would I feel about that? Mm-hmm. And I think it's important too. They didn't really get into it in the article, but I think how would I to frame it? How would I feel about that if I'm sustained at that lower level for maybe 2 to 3 years, which is a typical market recovery? You know, is that an unsettling feeling? And if it's unsettling, then maybe you need to reduce the amount of equities that you have inside of the account.
Yeah, right. Especially in this article specifically, they were looking at older clients who may be taking income from the portfolio. So instead of taking it from a much larger base, you're taking it from a smaller base, and it can compound on the downside.
Yeah. Another thing I think to be cautious about, we talk about, okay, a 65 to 70-year-old investor. That 65 to 70-year-old investor could still have a 25 to 30-year time horizon for their investments. And that's the other risk too, is that there's no such thing as a finish line when you hit retirement age or 70 or anything like that. There's still a long ways to go. So if you take off too much risk, you might jeopardize the long end, especially with higher costs or long-term care or something like that. So I think what we're really trying to get at is, how do we become better investors as the circumstances change, which brings up our second article, which is called The Perfect Investors from Market Watch. Katie, they talk about the idea of grit and just kind of muscling through and everything else when you get to choppiness in the market. But the author says that's not really what you need. It's more something else. What did they come up with in the article about the perfect investor?
Yeah. I actually really like this article. It contrasted that. So it's not about powering through with your investments. Oftentimes it's about taking a step back and letting the plan work, and letting things unfold and having a watchful eye on it, but not necessarily powering through that change. And I thought it was interesting too, because they had made some references in there. Sometimes it's searching for that perfect investment, that perfect stock, that perfect manager, when really the one that's going to make the difference is the investor themselves, and to focus on attitudes and habits more than finding that perfect solution.
I think the attitude part, especially now, is really important. I mean, there's just a lot of pessimism out there, and you see it in the numbers. I think there was an article that came out the other day that the pessimism levels are approaching back where they were in the early stages of the pandemic, and lots of stuff plays into that. There's just turmoil. It's that time of year, all of those things. But the first thing they mentioned, attitude, is trusting in the future. Now, we've all been through a lot. As advisors, we've seen a lot of things in the last so many years, and we're under no illusion that bad things can't happen. But you have to trust that there is an optimistic future. If you don't, then you get susceptible to really bailing on your strategy, right?
Mm-hmm. Exactly. Yeah, the trust in the future, and the resilience and the perspective and the patience, once again, to kind of let the plan unfold, to allow time for your strategy to work. All of those lead to good investing, a good investing discipline. And if you have your habits in the background kind of supporting that, habits related to spending and savings, as long as you kind of keep those things in check, then that, as they say, kind of bundles together for the perfect investor.
I did like the one line in the article where it goes over what the best investor could do, or what they feel. The best investor acknowledges that they experience both fear and greed. So when the stock market's going up, you feel the greed that you want to keep getting more and more aggressive, get the ride up. But then obviously when we have sell-offs, you experience the fear too. And the hardest part is obviously not selling out when we're on the downturn, and not going way too aggressive when we have a good market too.
Yeah. Another habit that was the delaying of gratification, and they use it in terms of spending, spending less than you make, and kind of not buying everything today. But I also think as investors, there's this idea of delayed gratification and returns. Like sometimes sometimes you go through these periods where, if you look over an 18-month period, I might be right back where I started because the market just goes into a churn a little bit. But that's the price that we pay sometimes in waiting for those, few months or few years where things really do take off. Sometimes you get 2 or 3 years of returns in a 6-month period, but you have to wait for it. You have to be patient and recognize that if it was all easy, everyone would do it. But that's why it's hard, Yeah.
And diversification plays right into that. I know we've had the conversation lots of times. If you're well diversified, then something's always underperforming. So having that patience and delaying that gratification to see, certain asset classes really contribute to the overall goal. And you have to have enough time under your belt to see everything working as it should when it should.
So true. Well, so speaking of delayed gratification, it's been a little while since the Bengals made it into the Super Bowl, or in a playoff game for that matter. But we have the Super Bowl coming up. Do you guys have any picks heading into our Rams-Bengals home game in LA?
I'm going to root Midwest. I can't help it. I have to root Midwest. So I'm going to go for the Bengals and root for them. And it is exciting. What is this? The third time time ever that they've made it, and they haven't won yet. So this could be their year.
I was born in Cincinnati, so I'm going to root for the Bengals. So I unfortunately think the Rams will pull out the W, but I'm hoping the Bengals can win. It kind of reminds me of the 2017 Eagles run. Nobody was really expecting it, and they came and won the Super Bowl. So I'm hoping the Bengals can do that.
All right. How do we not know this about Cody, that he was born in Cincinnati? We've never talked about Skyline Chili or Montgomery Inn Ribs, or what is that place? Anyway, we've got a lot to talk about.
Montgomeryville Barbecue. Yeah.
That's right. Yeah. We've got a lot to talk about after this video is done. All right, Mike. I'm going with the Bengals. There's no East Coast teams in. Ravens are out, so I'll root for the Bengals. It's pretty fun. I did see Ickey Woods give Joe Burrow a big hug on the sidelines. If anybody remembers Ickey Woods back in 1988, that was the Ickey Shuffle. It was great. All right. Well, thanks for humoring us today. Talking about a little behavioral investing, really important stuff. Habits, attitudes, all of that matters to becoming a better investor. Not perfect, but better. And if you have any questions, feel free to reach out to our team anytime. Have a great week.